Hey friends, I wanted to bring you outside with me again, get some fresh air together, have a nice casual chat. So today's video is about the economic Armageddon that we're going through right now here in the US and the rest of the world. But before we get started, I want to share with you two quick stories. I was at McDonald's the other weekend, and I witnessed a father having to tell his children that they couldn't get additional French fries or drinks to go with their order because it was out of their budget. And this was a huge reminder about the pain that inflation is causing so many good people here in the US. A separate week, I was shopping with my parents at TJX, the discount retail store. I get a lot of my clothes from there, by the way. It's really good, high quality clothes. And I saw a father tell his family that things are too expensive in this store. We can't buy from here. And then he yelled out loud, "Things are too expensive." And then they stormed out of the store. I'm witnessing good, hard-working people get absolutely destroyed by inflation. And so in today's video, I want to talk about when I believe the Fed will pivot, what we need to look for. We'll talk about the central banking Armageddon that's happening globally. Then we'll talk about something that I think is insidious that's happening that could make food inflation stay entrenched. I'll talk about that later. So in order for the Fed to pivot, I want to remind our friends about the following things. One of three things need to happen. So let's remember this. Inflation needs to come back down or be on the trajectory back down to 2%. Unemployment needs to go up a lot more than what it is now, or there needs to be a big liquidity crisis, either in the bond market or in the stock market. Now, let's talk about each of them individually. So, inflation. We don't need inflation to come back down to 2% for the Fed to pivot. It needs to be on that trajectory, because inflation at 2% at this point, it's a joke. It's not happening. I want to be a little bit more casual. 2% inflation, that's not happening for years. And right now, CPI, core CPI, it's very stubborn, north of 8%. Core inflation, it's actually moving in the wrong direction. What's core inflation? My friends, core inflation is essentially CPI, but you take out food and energy because those are really volatile. And guess what? Core inflation, last several months, 5.9%, 6.3%, and then 6.6%. So core inflation is going in the wrong direction. Now, of course, these numbers will come down, but the Fed is not necessarily reacting to the forward outlook, and they're reacting to lagged economic data, which I think is disastrous. These numbers are definitely coming down, but because on paper they're still very high, the Fed has a lot of ammunition to move rates higher, front load their rates, meaning do it now, cause the pain now, so that there's not a lot more pain later. Now, maximum unemployment. That's one of the Fed's mandates as well. And right now, guys, it's at 3.5%, and it looks like the US economy is really healthy. But you want to know the dark side of this number? It's that the labor participation force, meaning the number of people actually working as a percentage of the workforce, that number is pretty much at like a multi-decade low. So even though the unemployment rate looks very healthy for the economy, the fact is not as many people are working. So this number is exceptionally misleading. Now, about the liquidity crisis, we're seeing giant gyrations happening in the stock market. But beyond the stock market is the bond market, and there's a lot of illiquidity happening in the bond market. That's why we're seeing the 10-year yield, the 20-year yield, those yields continue to march. Why is that? It's because no institutional investor right now wants to step in and buy the bonds, because the Fed was one of the biggest buyers of treasuries and MBS, mortgage-backed securities. Now, with the Fed pursuing quantitative tightening, we're seeing market liquidity in the treasury market really dry up. And that's why you've got those yields just climbing every single day. This is going to wreak havoc on the stock market unless there are institutional investors that are willing to come in and step in to buy bonds. Now I want to talk about something that I think is really important to put on our radar. And in my opinion, the food part of the inflation index, that is single-handedly what I believe to the most important area that people care about. Yes, housing is important, auto's important, transportation's important, but the most important part of inflation, the CPI component, is food. And you might have seen recently that Kroger is trying to purchase Albertsons. And this would make Kroger essentially one of the biggest monopolies for grocery stores here in the US. Now, Kroger was a name that I advocated for back in September as a big defensive play for our investment community. And because of the merger and acquisition, some of my members are wondering, is this going to impact Kroger? Listen, this deal is amazing for Kroger. If you're a shareholder in Kroger, you literally have nothing to worry about because they're going to be a monopoly if this goes through, if it goes through. Having Kroger in your portfolio is the least of your worries because if this merger goes through, here's what's going to happen. And I'm going to read this to you. This is very, very important. It would concentrate more than $200 billion worth of annual grocery sales and nearly 5,000 stores into the hands of a single corporate entity. And between the merged grocery behemoth, Kroger and Albertsons and Walmart, these two companies would reportedly control more than 70% of the market in 167 cities, 70% of the grocery store market. So let me ask you this. Since when has a monopoly ever benefited consumers? Now you might hear in the news, oh, Kroger and the Albertsons deal, it's going to lower prices for consumers. This is going to be better for everybody. But if we read in between the lines and we actually study the interviews of the CFOs and the CEOs, I want to read this to you here. Kroger CEO Rodney McCullen has argued that a little bit of inflation is always good in our business, a little bit, meaning the more inflation, the better, because consumers don't overly react to that. Gee, I guess why? Because people have to eat and they have no other choice. And at the same time, his counterpart at Albertsons, they said that businesses like ours, they've done well in periods when inflation was 3 to 4%. And so last year, he made this market prediction. He says, my sense is this inflation will just be passed through to consumers. Just great. And guess what? If they merge successfully, I think that this food inflation that we're seeing, this uncomfortable increase in the grocery bills for everyday good Americans, those prices are probably going to stay entrenched. So it's a double-edged sword. For people who think that Kroger, their company experiencing a little bit of share price weakness near term, long term, if this goes through, Kroger is going to be a massive juggernaut here in the US. It's not good for consumers. So I actually don't want this deal to go through, even if it's good for the name. Look, sometimes we have to think about the big picture, okay? Because if food inflation stays entrenched and Kroger's share price appreciates in a couple of years, so what? The rest of the market is going to be in pain. Consumers are going to be in pain. So we have to think about the big picture. Now, I want to talk about a couple things that we've been doing inside our community. Obviously, we've been sharing offensive and defensive names, but more than ever, I just want to say this big picture opinion here. Guys, we have to choose companies that make sense. Just be as safe as possible. Back in September, I told our friends inside, I think Dollar Tree, I think Kroger, I think Johnson & Johnson, those are going to be some of the best names in this environment. And since then, those three names have done really well, especially Dollar Tree. The thesis is really simple. Here, people now have less money to spend. People are less confident. And that just means one thing. These consumer dollars, they're going to go to companies like Walmart, like Dollar Tree. So I just urge my friends to not speculate on the riskiest part of the markets right now. Play it a little safer. Wait for a little bit more confirmation, because there are a lot of unknowns. There are a lot of unknowns right now. I'm always sharing exclusive research inside my email list, on my Twitter and on my Instagram. I'm going to do as much as I can for our good people. Thank you guys for your support as always. If you're in my Patreon community, I wanted to thank you again for your support. And if you guys want exclusive research, I'm really excited to help you succeed. Let's crush it together. This is a really tough environment. This is really, really tough. But we're going to stand strong and we're going to crush it together. But what we got to do is we just have to, play it safe until the Fed decides to be a little bit more rational. Now, as we look towards the end of the year and we enter the holiday season, I just want to share with you something profound that I found on LinkedIn, and I want to read this to you here. And this post says, most would kill to see this come up on their phone again. So if you get these, you are blessed. Look at this image. It's deep, it's profound. And basically, what it means is this holiday season, spend quality time with mom and dad. Spend quality time with your family. Because at the end of the day, when things are tough, your family will always be there for you. So do something nice for mom and dad this holiday season. Take them out, have a good time with them. They're always here for you when you need them. And with that said, I'll see you guys in my next video.